Welcome back to FX Street. It's 8:30 a.m. Eastern. Today is April 10th, 2012. Welcome back, one and all. Great you could join us. My name's Adam Rosen. Very happy to be here today. This is a kind of an interesting, well, I would hope that all our webinars are interesting, but I think this is quite interesting. What we're going to take a look at today is an approach, I'll be perfectly honest with you, that let me say it this way. This is the first time I've used this approach, but I think it's something, I might stumble across something that's kind of interesting. Okay, what we're going to look at is fundamental analysis and technical analysis and how the two work together. Fundamental analysis is the news. News moves markets. The number one reason why the Forex market moves is traders expecting higher or lower interest rates. Of course, that doesn't happen every day. So we look at the incremental news, the CPI and the non-farm payroll numbers and all these other great numbers to try to guess what that central bank is going to do. If they're going to raise interest rates, lower interest rates, or keep them unchanged. That's fundamental analysis. Technical analysis is looking at the charts to discern price patterns and hopefully, really, I think the goal in technical analysis is to identify the trend. Now, putting the two together is the goal of this webinar. What we're going to try to do is create a narrative where a piece of news is released. That news indicates that an economy is better or worse, is functioning better or worse than we might have expected. And then based on that news, we want to look to the market to see if that market is behaving in a way that it should. And sometimes it does not, and that can be a very strong clue. Now, in an ideal world, remember we trade currency pairs, so there's two currencies in the pair. We want one currency to go up and one currency to go down. If we buy here's the CAD yen. If we buy the CAD yen currency pair, we want to buy the CAD yen because the Canadian fundamentals, the economy in Canada continues to improve while the economy in Japan continues to deteriorate, to weaken. So hopefully you get the greatest separation. The greatest trends that emerge in a currency pair is when one currency goes up and another currency goes down. Now, sometimes you'll have two currencies that move in the same direction. You get range-bound markets, but they're not very lucrative. You look at, an example, by the way, is the dollar CAD. Here's a range-bound market. Market has done almost nothing, the dollar CAD, over, a few months now. This is the dollar CAD. Now, it's true we could use a buy low, sell high approach over and over again, but it's not very lucrative, and eventually we're going to be wrong if we buy and it breaks down, or if we sell short at resistance and it breaks out. So not really the ideal situation. The ideal situation, if you look at the CAD yen, here's the daily charts. In this situation, the yen was going down and the CAD was going up. I'd like to believe this was as a result of improving fundamentals in Canada and at the same time weakening fundamentals in Japan that sent this CAD yen skyrocketing. I mean, literally, from February 1st through March 20th, in less than 2 months, the CAD yen went from 75, below 7,600 to above 84. We're talking 800 pips in 6 weeks. This is a lot easier to trade because we're obviously going to trade in the same direction as overall trend, which is to the upside, and so that means we buy. Now, where we buy and how much, that's up to us, but hopefully we're going to buy when the market pulls back. Hopefully we're going to put our protective stops at levels that the market won't touch, and hopefully we won't buy so much that on one little pullback we're going to get stopped out or we're going to get a margin call. But let's assume that, we give ourselves good stops and we don't trade too big of a position size, and we're waiting for at least some kind of pullback. Pullback, we can use any technical indicator. Bollinger Bands, moving averages, RSI. If you wait for the pullback, you use proper risk management, and you use wide stops, you have a very, very good chance of making money when you're able to capture a trend like this. What we're going to do today is going to try to read the tea leaves to interpret a chart, interpret a currency pair based on both currencies, fundamental and technically based. Okay, so we're going to start with the CAD yen. CAD yen is an easy example. Now, what I did, let's go over to the FX Street calendar for a moment. This calendar, by the way, is something that is crucial in this situation. Okay. Now, what's really cool about this calendar is I put in the dates March 1st through April 30th. It's the only calendar I know that actually does this. It's kind of cool. March 1st to April 30th. So we're capturing a nice amount of time. Obviously, not April 30th, we're not there yet. But starting on March 1st. Now, you can check off the individual countries, and you can press the hide button to hide all these details, but we have them exposed. I only want to look for the information that applies to Canada at this point. So I place a check mark next to Canada, all the other check marks I took away. In addition, you have this little slider feature below, and I moved it all the way to the right-hand side. So you have 3 exclamation points. What that does is it's marked as volatility. I'm not exactly sure how it's calculated, but basically it shows us only the most significant events. If I were to move the slider all the way to the left-hand side, you're going to get a lot of little news, which we don't want. You know, usually the 2 right-hand positions with 2 or 3 exclamation marks, will give us the most significant news. In this case, I only moved it to the 3 exclamation points, all the way to the right-hand side with 3 exclamation marks. Practice with this. Experiment with it. You'll see what I'm talking about. It's actually very, very simple. Okay? So basically what I've done is this. I've looked back to March 1st until today, and I've filtered out only the very significant news that has occurred in Canada. On that date, I didn't get exactly the right time, but on that date, whether it's March 8th or March 23rd, I drew a vertical line to mark off that moment in time that piece of news is released. And this helps us create a little bit of a narrative. Okay, so let's go back to the charts. I don't know if you're able to see the charts and the news at the same time. This is the calendar, by the way. You can also follow along with me if you can't. I don't think you're able to see both, so I'll leave it on the charts. But I send you the link for the calendar, so you can follow along as well. So going from March 1st through today, only the most significant pieces of news released in Canada include March 8th, Bank of Canada interest rate decision. The interest rates were expected to remain unchanged at 1%. They did remain unchanged at 1%. I don't know what the Bank of Canada statement said. You know, we didn't really have a chance to go back and pull the statement. We do during the central bank reviews, by the way, but it's very, very easy. Go to Google, look for Bank of Canada, and you'll find the official Bank of Canada website. You can pull up the statements from the March 8th decision, and they'll talk more about the fundamentals of the Canadian economy. Okay, they'll say, we decided to keep interest rates unchanged. We believe inflation is going to be here. We believe employment is going to be there, and we believe GDP growth is going to be here. We don't know what that is because I didn't have a chance to pull it up. But let's assume we did. March 8th, Bank of Canada interest rate decision. They left interest rates unchanged at 1%. I'm assuming that whatever their statement was pretty positive, because the CAD-yen currency pair on March 8th was 81.55, and we can see what happened after the fact. It started to skyrocket to the upside. Again, the number one reason why Forex currency pairs move is the expectation of higher, lower interest rates. So whatever the Bank of Canada said on March 8th, I'm guessing that they're making, let me say it this way, they're more likely to raise interest rates in the near-term future based on the information released on March 8th. March 9th, the next green line on the left-hand side, Bank of Canada releases their unemployment rate. This we do know. The previous number was 7.6%. The consensus was that the unemployment rate would stay unchanged at 7.6%. The actual number, 7.4%. The unemployment rate dropped, which is good news. Employment increased. And they look at the net change in employment. It was actually a negative 2,800. But we do have the unemployment rate which dropped. So I'm going to take their word for it. That was released on March the 9th, and we can see after the fact, we had a little of a case, I think, of buying a rumor, selling the news. The CAD yen went up a lot running into the number. We pulled back, but over the long term, so far the two numbers, Bank of Canada interest rate decision, unemployment levels, I'm guessing both of them, well, the unemployment number we know was better than expected. Bank of Canada, I'm guessing, was better than we expected. The CAD yen continues to do well. It's just the same way if we owned a stock in our 401k, Apple Computer. I always like to do so. As an example, Apple Computer comes out with earnings and said, guess what? We thought we were going to sell 100 million iPads. We're selling 200 million iPads. It's even more popular than we ever expected before. We told everyone we were going to make, $3 per share in earnings. We're making $10 per share. If I was a shareholder, I would say, great, good to go. I'm going to hold on to my stock. Nothing wrong with that. On the other side of the coin, you take a company like RIM. They make the BlackBerry. And they come out with their earnings, and I'm making this news up, obviously. But BlackBerry comes out, and they say, you know what? We told everyone we're going to sell a lot of BlackBerries. Well, Apple Computer's killing us. We're not. And remember how we told everybody that we're going to make 30 cents per share? We're not. We're actually going to lose some money this quarter. Well, if I owned BlackBerry stock, I would not feel very comfortable. I'd probably sell it, and I'd probably sell it and exchange it for something that's working a lot better, like Apple Computer. And that, by the way, is exactly how arbitrage traders in the stock market work. They buy the strong and they sell short the weak. Well, it's no different for us. Forex traders, we're buying strong, we're selling the weak, but we're doing that at the same time in the same currency pair. Think of the CAD yen, and we're only looking at the Canadian fundamentals so far. But remember, we have Japanese fundamentals as well in the CAD yen. But, if the Japanese fundamentals were poor and the Canadian fundamentals were improving, we'd buy the CAD yen the same way if it was in the stock market and we had not currency pairs, but we had stock pairs. I would buy Apple, sell BlackBerry, and buy the Apple-BlackBerry stock pair if that existed. Well, for arbitrage traders, that's exactly what they do. But Forex traders, it's a lot easier because the pairs are created for us. That's exactly what we want to do, first from a fundamental point of view, and then we want to look to the charts to make sure the news is the market is behaving in a healthy way. Go back to our Apple BlackBerry example. If Apple is coming out with such good numbers and BlackBerry is coming out with such poor numbers, I will expect that the Apple stock will continue on a percentage basis to outperform the BlackBerry stock. BlackBerry meaning RIM. That's a company name. If all of a sudden the good news continues to come out of Apple and then Apple stock stops going up, that's a danger sign. Always be very aware of the danger signs. The danger sign is when a stock, or in this case a currency pair, starts to ignore good news or starts to ignore the bad news. It can be a very big sign of something new to come. If you go back, I don't have the charts in front of me, but if you go back and look at the fundamentals of the U.S. economy back in 2007, 2008, the first thing that happened was the fundamentals started, or the market started to ignore the fundamentals. If you look at, for example, and I don't have it in front of me, but if you look at, for example, new home sales or GDP or CPI, non-farm payrolls, the big numbers, they actually started to weaken well before the stock market weakened. And this is before quantitative easing, before stimulus, Operation Twist, anything else that could have clouded the performance of the stock market. The stock market kept on making new highs as the fundamentals in the U.S. economy really started to crumble. And that's why a lot of people who sold short the stock market early really did very well, because they noticed, and these are the best trades. The best trades, in my opinion, come when you're able to notice not just one or two news events, but when you're able to really notice a market that is starting to ignore the news, a market that's going down, 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 and then all of a sudden the news continues to be bad, and the market starts to go up. The market's ignoring the bad news. Maybe the market's telling us something different. A market that's going up, 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 and all of a sudden the news starts to get bad, it's ignoring the bad news. Maybe that means it's going to start to go up. maybe in the case of the U.S. economy, we're going to see a convergence. Well, we always see a convergence, but maybe we're going to see the stock market go down. In other words, to keep it simple, generally speaking, the market and the news usually go in the same direction. When they start to diverge and go in opposite directions, that's not normal, and that rarely lasts. So everybody should be extremely aware of that. Now, going back to our chart over here, we look at March 23rd. Bank of Canada Consumer Price Index. The previous figure was 2.5% year over year. The actual figure, 2.6%. Better than expected. Bank of Canada CPI year over year. That's a core CPI, I should say. 2.1 was the previous month. Actually came out 2.3%. Now, the consensus numbers is a little bit deceiving because there'll be difference depending on which calendar you use. So I like to take the consensus numbers with a little bit of a grain of salt. You take a look at the FX3 calendar and they give you the consensus number, where it's basically a poll of a number of different analysts. But you take a look at the Bloomberg.com, calendar, and they might be asking different analysts. Whoops, I'm sorry. I'll refresh the chart here. So the consensus is basically a bunch of analysts getting together and guessing which way the CPI is going to go. If you ask 10 different people the same question, you're going to get different answers. So the consensus, I don't like to, I'll take it with a little bit of a grain of salt. I mean, and what I'll actually do, if you have the time to do this, it's really valuable. Look at a couple different calendars. Non-farm payrolls last Friday. The consensus on one side was 203 or 202,000 new jobs to be created in the U.S. And another calendar, I think it was as high as 220. The actual number was 120. That's what we really want to see is a shock when the number is much better or much worse than all the analysts' estimates. Question. But when the market does not follow the news, does this happen continuously on every news concerning the same currency? I make it sound very simple, very easy, very noticeable. It's rarely that easy. It's something that you'll notice over time that develops. I like to say a trend is not made up of one economic number. Last Friday we had core non-farm payroll numbers. That's just one number. We have CPI coming out later, I think this week, and PPI, Producer Price Index in the U.S. If those numbers are good, what does that tell us? It means the employment is bad in the U.S., but the inflation numbers are good. The GDP could be bad and the trade balance could be good. Usually an economy is made up of conflicting numbers. And that's why usually currencies and currency pairs don't have a very smooth trend. What you're looking for is an overall majority. And the word narrative, I think, is the best way. It's just like us. There's 7 days in a week. On Monday, I had a good day. On Tuesday, I had a good day. On Wednesday, I had a really bad day. Thursday was good, and Friday was okay, and Saturday was really bad. It's not really, really good or really, really bad. Most of the time, over time, looking at the news, I like to see which way the trend is going. I mean, so far, the Bank of Canada interest rate decision, we don't know what happened. The unemployment rate was good news. The CPI was good news. April 5th, which is a line on the right-hand side, the unemployment, again, 7.2%. The previous month was 7.4%. More good news. The previous month, remember, we lost 2,800 jobs in Canada. This month, on April 5th, right over here on the line all the way to the right-hand side, I picked this chart for a reason because it's a real shock to what happened. On April 5th, the employment number was much, much better than expected. All three events in Canada were good. I'm guessing the Bank of Canada interest rate decision was also I seem to remember it being positive as well. But this last number was actually the best. The last month, the previous month, we lost 2,800 jobs in Canada. The consensus, for what it's worth, that analysts were expecting 10,000 new jobs to be created. What was the actual number? 82,000. Much, much better. It was 8 times as good as expected. The unemployment rate in the past 2 months has dropped from 7.6 to 7.2, 7.6 to 7.2%. So, you have from March 8th through, well, basically April 10th, in 1 month, you've had the Bank of Canada meet. They left their interest rates unchanged. I seem to remember the news was good. The unemployment rate dropped. CPI was better than expected. Unemployment rate dropped again, and the latest employment numbers are unbelievable. Wouldn't we expect the CAD currency and the CAD yen currency to be going up? This chart is a huge warning sign. This is a danger sign. After all, okay, ignore the Bank of Canada because we really don't know what they said. The closing price of 83.34, let's say 8,300 was on March the 9th. Let's draw a line here. This is 8,300. This is basically where the CAD yen was, the horizontal line. Please let me know if you can't see it. This is basically where the CAD yen was when the unemployment rate first dropped. Then CPI, and it went up, and that's good. We expected to go up. The news was good. The next line over here, this was the CPI, again better than expected. But now, think of it the same way as Apple Computer. We would have expected this currency pair to continue to go up. The news was better than expected. The news continues to get better, to be better than expected. And then the CAD yen. It's the same way Apple Computer says, guess what? We're selling more iPads than we ever did before. And you look at the stock and it's $300 a share. You say, what's going on here? I thought this company was doing well. What's wrong with the stock? And that's exactly the question that we should be asking. This, by the way, is a 4-hour chart, if that's what you're referring to. We should be asking ourselves, what's wrong with this chart? What's wrong with this currency pair? I thought the news was better than I thought things were good in Canada. The final number on the right-hand side, and this was by far the best piece of news. The unemployment rate drops 2 basis points to 7.2%. Remember, we're at 7.6. I mean, in the U.S., that's like going, we're at 8.2. That's like going from 8.2 to 7.8 in 1 month. And the employment number was 8 times as good as expected. We were expecting 200,000 new jobs. It was like, that's the equivalent of last Friday's non-farm payroll number to be 1.6 million new jobs. If we had a non-farm payroll number of 1.6 million new jobs last Friday, I think the Dow Jones Industrial Average would be 15,000 right now. Obviously, I'm exaggerating, but it was pretty much ignored, by the way, because everybody, at the beginning of the month focuses on non-farm payroll numbers. They forget about Canada every single month. This number was fantastic in Canada. And you look at the CAD yen, it's at 81.05. If I bought the CAD yen at the beginning of this good news at 8,300, I'd be losing 200 pips right now on 3 really good pieces of news. Now, I'm not taking into consideration 2 things. Number 1, Japan, the other side of the currency pair. We didn't talk at all about the fundamentals in Japan, which does play 50%, contribute to 50% of this currency pair. Maybe the fundamentals of Japan were that much better that yen went up, forcing the CAD yen to go down. The other thing we have to take into consideration is exterior forces. Trading Forex is actually a lot more involved than I used to think it was. I used to think, well, it's a chart, if it's an uptrend, I'll buy it. If it's a downtrend, I'll sell it, and I'll use some moving averages, and that should be enough. But the more I look at it, the more I learn, the more I realize how much I don't know. It's a good sign because it forces us to learn. So forget about the Japanese economics for a second, fundamentals for a second. Why would the CAD yen go up? Now, everybody knows oil and oil benefits. A lot of oil comes from Canada. That's part of their economy. But aside from that, the Canadian dollar is considered a commodity-based currency. Commodities tend to go up when the stock market and the economy goes up because we can afford more commodities to increase in manufacturing, to travel, airline tickets. We take more vacations, we drive more cars more. Oil goes up, commodities go up, the Canadian dollar goes up. We also have a difference in interest rates. I guess that would be number 3, which is a carry trade. The difference in interest rates between the two. So let's say number 1 is the factors we have to take into consideration fundamentals of each currency within the pair. Number 2, how do we say this? It would be exterior factors such as a commodity, currency, lower yielding versus higher yielding currencies, which is also considered the carry trade. Now, you really want to get complicated? This is the way you do it. You find a carry trade, which is a currency pair where you have a large difference in interest rates. Canadian dollar doesn't, we only have 1% in Canada, but if the economy improves, we know that 1% will go up over time. And we know Japanese rates are low, and they've always been low, and they're really not going to go anywhere. At the height of 2007, when every economy was doing very, very well, interest rates in Japan were only 0.5%. Okay, so Canadian's a carry trade. You find a carry trade where the economics are good, and I say I want to buy that. When the market does not like the carry trade, meaning when CAD yen goes down because stock markets go down, CAD yen, Aussie yen, Kiwi yen, dollar yen, all yen crosses will go down because capital moves into those lower yielding currencies like the yen. And when the stock market goes up 300 points, Aussie yen, Kiwi yen, CAD yen, Euro yen, Pound yen, Dollar yen, they'll all go up. So wait for a pullback, wait for the stock market to go down, then we buy the pullback. But what do we buy? Do we buy the CAD yen or the Aussie yen? We buy the one with the stronger fundamentals. Okay, so number 3 is use pullbacks, market pullbacks to buy strength and sell weakness. So we haven't looked at Australia yet, but if we were to look at the Aussie economy and we were to determine that, well, their economy is not so hot, then I'd want to sell the Aussie on strength. Does that make sense? Let's go to, I didn't mark off the Japanese numbers over here, but let's go to a different chart because I have a lot more and I don't want to miss out. Okay. So we're going to change now from Canada. We're going to take away Canada. We're going to look at 2 together because there's 2 currency pairs. We have 2 currencies within a pair. We look at the U.S. and Australia. Put together Aussie dollar. Now again, and you can follow us. You can follow on your own calendar as well. I sent everyone the link. Okay, so the green lines represent the news out of Australia. The purple lines represent the U.S. news. Okay? One by one. And we notice, by the way, the overall trend is to the downside in the Aussie dollar. So we're going to continue to look for symptoms. By the way, to wrap up really quickly, in terms of the CAD yen, why did the CAD yen go down and the economy continue to improve? Well, it's either we didn't look at the Japanese fundamentals. It could be either the Japanese fundamentals are so much better than Canada that it's forcing the CAD yen down. I don't think that's the case. It could be the major market sentiment where capital is going into the yen, the lower yielding currency, because stock markets have been going down. I think that is the case. It's some kind of exterior force that's affecting the markets. Now, we did a lot of analysis on Canada, and we know their economy is improving, but that does not necessarily guarantee we're going to make money. We have to take everything into consideration. Question: why riskier currencies go up when stock market goes up? I don't see the connection clear. Great question. Think about stocks. In 1999, when the tech bubble was in full swing and we could not pick a bad stock, every stock went up. What stocks went up a little bit? Ford, General Motors, American Express. They paid dividends. They were slow and steady. What stocks went up a lot? Pets.com, Qualcomm, WorldCom, everything com, because they were risky stocks, because they're speculative stocks, because they had the potential to have multiple, their earnings would increase exponentially. Ford is the biggest truck maker in the world, but they have so many factories, and they have so many employees and unions and expenses. They hope instead of selling 30 million trucks, they're going to sell 40 million trucks. But to sell 40 million trucks, they have a lot more employees and expenses, so the profit margin is not going to explode. What was in the news? What's this company, Instagram? Maybe you might have heard this news. It wasn't publicly traded, but listen to this story. This is unbelievable. There's a company out there. They made a little application for the iPhone where you're able to take you take a picture, you press the app button, and it, I don't use it, but it changes effects to the picture. It has a little social networking function to it. The company has 13 employees. Facebook just bought their company yesterday for $1 billion. 13 employees get to now own a company or work for a company that's worth $1 billion. And I'm sure they don't divide it evenly. I'm sure the guys at the top get more. That is a speculative company, because the company that makes and they don't have any revenue. They're not making money. They're hopefully one day they will have profit. It sounds like the dot-com bubble all over again. But that's the kind of company that could either disappear tomorrow because nobody's ever heard of them, and they don't make trucks like Ford. They make an iPhone application that, I frankly think a lot of other people could probably make. So when things are bad, they could disappear. When things are good, they could be worth $1 billion. Lucky for them, things are good. Same thing. So my point being is this. I've drifted off course here. My point being is that in any market, there's more or less volatile participants in the markets. You have low yield, you have safe treasury bonds that pay a low yield. They go up and down a little. You have high yield bonds that go up and down a little, go up and down a lot. When the stock market, to answer your question, when the stock market goes up and there's a general feeling of optimism in the air, traders say, hey, let's make some money. Let's take some risk. Just the same way I'm going to invest in this Instagram company because, maybe they're going to go out of business, but I think they're going to get bought out. Let's take some risk. And lucky for them, the risk paid off. When we take risk in the foreign exchange market, we're buying currencies with a higher yield, like the Aussie and the Kiwi, because there's more of a likelihood. First of all, if we invest in the Aussie currency, like if we put money into an Australian savings account, we have a greater chance of making more money. In Australia, interest rates were 4.25%, I think. You get paid 4.25%. In Japan, we get paid almost nothing. So when things are good, well, let's take the risk. Things are really good, let's take a lot of risk. Let's buy the Brazilian real. 10% interest rates, or somewhere near there. I forget exactly where. But when things are bad, who's more likely not to pay you back on your investment? A bank in Brazil or a bank in, I was going to say Europe, that's a bad example, a bank in the U.S. or a bank in Japan or a bank in Switzerland? You take more risk with a higher yield, and in turn, the higher yield reflects more risk. Think of Greek bonds. Greek bonds paid at 1.30% interest rates. Why? Because there's a 95% chance you weren't going to get any money at all. But if the 5% chance that you were going to get paid, you're going to get paid 30%. The bonds and the currencies work in the same way. They're going to pay you higher yield when they have to. Look at today's trading activity in the bond market. Italian bond yields up 2.75%. Portuguese bonds up almost 1%. Spanish bonds up 3.3%. Doesn't mean those bond yields in Italy, Spain, and Portugal are not up because things are so good. They're up because there's more risk. In Spain, there's no one person saying this, but the bond market is saying, hey, we're in trouble. We need investors. Investors don't want to invest in Spanish bonds because they think we're going to default. Let's increase the yield to attract investors. And investors are saying, listen, no way, I'm not buying Spanish bonds. I see what happened to those of my friends that bought the Greek bonds. Let's pay them higher yields. We have to. It's just a natural component of the financial markets, especially in bonds and in currencies. That when the stock market goes up, the higher yielding currencies tend to attract more capital simply because we can make more money in higher yields. But we're only going to buy those higher yields when we know or when we have a reasonable chance or actually get paid on our investments. I hope that answers the question. I'm running out of time here. Aussie Dollar. I talked too much about one chart and I left that left. Okay, so Aussie Dollar, the green lines again represent the Aussie figures. March 6th, Reserve Bank of Australia interest rate, they left unchanged at 4.25%. I don't remember what that statement was, but, I'm not even going to guess. March 8th, unemployment was at 5.1%. It went up to 5.2%. That's that second green line. That's worse than expected. The employment number, the previous number, this is not the consensus, this is just the previous figure. Previous month, we had 48,000 new jobs created in Australia. This month, they lost 15,000. That was a real disappointment. That number, that figure occurred on March 8th. Now, if you notice, if you actually zoom in on the chart, you'll see the market went down, the number was released, and the market actually went up. I don't know if I drew this line exactly right. On a short-term basis, beware of buying the rumor, selling the news. The market will go down. A bad piece of news is released, the market will go up. Because a lot of traders, remember, employment numbers in Australia are based on employees. And a lot of analysts, a lot of really smart individuals out there are asking the biggest companies in Australia, how are things? Are you guys hiring or are you guys firing? If I was going to poll the U.S., if we wanted to get inside information on the U.S. unemployment level, unemployment rates, and there's no such thing as inside information in Forex, It's like in stocks, you go to jail. In foreign exchange, everybody knows the employment number at the same time. How could we get an inside look into the employment number? Well, we would look to the companies that represent the U.S. economy. There's a lot of them. I would start with the 30 stocks in the Dow Jones Industrial Average. Ford, American Express, DuPont, etc. Great point, by the way, private polls. I'm going to talk about that. But let's start with the 30 stocks in the Dow Jones Industrial Average. Caterpillar, I think DuPont, American Express. Go to each company and try to get an idea. And I don't know if they announce it or how this would be done, but this is what those individuals in private polls do exactly. They go to the big companies and say, hey, you guys hiring? You guys firing? And obviously sector to sector, banking stocks, the banks have been firing while tech companies have been hiring, so we have to, there's a whole science to that as well. Now, the private polls, remember, they're asking different people the same way we ask different analysts depending on which economic calendar we watch. Bloomberg is asking Bloomberg analysts. FX Street is asking different FX Street, analysts. Do you have the initial jobless claims, which is every week? You have non-farm payrolls every month. You have the ADP numbers. Those are all different. And there are divergences. There are differences between them. And you'd be amazed how inaccurate the U.S. unemployment levels actually are. They don't ask 300 million people in the U.S. if they're hiring, if they're working or they're not working. Nobody ever asks me. What they do is they take, they ask a few 100,000 people. There's 300 million people in the U.S. They only ask a few 100,000. And it does not count those people that have dropped out of the job hunt. They said, you know what, I've been looking for a job for 2 years. I can't find anything. I give up. Those people don't count. The people that are working but they're not making as much money as they used to, they don't count. That counts as a regular employee. So it's not a perfect science. They basically ask 100,000 people or a few 100,000 people what your status is, and then they extrapolate that out. They say, well, if 200,000 people said this, then 300 million people would have said that. Okay. Nevertheless, the number was very bad. So fundamentally, I'm expecting the Aussie to go down because the fundamentals were not good in Australia. Now, the purple lines represent, the last green line, by the way, all the way to the right-hand side, that's another Aussie. That's on March 20th. Well, I missed the line, sorry. Go to all the way, Aussie, April 23rd. Nope, that number didn't get released yet because it's not April 23rd yet. Aussie number is what I'm looking for is April 2nd. We're right around there. Okay. Interest rate decision, April 3rd. Reserve Bank of Australia met. I don't know what they said. We didn't look at their actual statement, which would be very helpful. But whatever they said, it looks like a continuation to the downside. That things are not good, I'm guessing. Now, all the purple lines represent U.S. numbers. Start from the left-hand side, March 9th. Non-farm payrolls, the previous number was 275,000 new jobs. The actual number, 240. Now, the consensus was 210, so it beat the estimates, but it showed a decline. So how do we interpret that? I don't know. The unemployment rate stayed unchanged at 8.3%. Let's look for March 16th, which is over here. U.S. CPI was 2.3%, dropped down to 2.2%, worse than expected. The Aussie dollar actually went up after the fact. The small move was that the Aussie dollar went up. Bad in the U.S., the dollar is the second currency in the Aussie dollar pair. Aussie dollar goes up. That's a logical move. U.S. GDP, March 29th, which is over here. U.S. GDP was 1.8%. The most recent result was 3%. Better than expected. Dollar, that's good news for the dollar. Aussie dollar goes down after the fact, which we would have expected, at least in the last the 2 days following the 1 or 2 days following that number. Now, and I told you it's not so easy. The big number I wanted to focus in on, April 6th, last Friday, non-farm payroll, much worse than expected. Last number was 240,000 new jobs. FX Street's expectation was 203,000 new jobs. The actual number, only 120. The unemployment rate was 8.3%, dropped down to 8.2. How's that possible? The number was much worse than expected and unemployment dropped? Well, analysts very quickly came back and said, hey, the number was bad. Less people that were trying to work are now working. So overall, it was a really bad event. We know this because the stock market went down yesterday. Well, that number that's bad for the U.S. dollar, we would guess would go up for Aussie. But remember, there's different factors that affect a currency pair. It's not only the fundamentals of Australia and the fundamentals of the U.S., it's also the exterior forces like the carry trade and the fact that the Aussie is a commodity-based currency. If the news is bad, traders are saying, I'm selling the dollar. And that's it. I'm selling the dollar. I don't believe the Fed's going to raise interest rates anytime soon. And not only they're not going to raise interest rates, I think we're going to see QE3, and that's going to be really bad for the dollar. So why wouldn't the Aussie dollar go up? Because the exterior forces being carry trade, you have much higher interest rates. So you have 10 people in a room. 5 people say, sell the dollar, things don't look good in the U.S. based on NFP, non-farm payroll. The other 5 people in the room are saying things don't look good in the U.S. and things don't look good overall, and we have much higher interest rates in Canada than we do in the U.S. Not Canada, I'm sorry, Australia. Sell the Aussie. So you have 10 people in the room, 5 of them are selling the Aussie currency, the other 5 are selling the dollar. That's a range-bound market. When the Aussie, people are selling both. So what happens? Exactly what has happened. Range-bound market. This is a clear sign that I don't think a lot's going to happen. Now, overall, I happen to believe that the overall trend will go to the downside because you still have the possibility that the Reserve Bank of Australia will cut interest rates further. So overall, I think you still have a lot more downside risk. There's just so far the dollar can go down. But if we have QE3, that could add extra selling pressure to the dollar, at least in the short term. But then again, that could lead to further selling in the Aussie as well. Point being, it's not a clear picture. When there's not a clear picture, I'm not touching the currency pair. I happen to think it's going to go down, but I really don't know. I don't have a clear opinion either way. This is not an ideal situation. Remember, an ideal situation is when one country's currency has really, really good fundamentals and things look great, and the other one is really, really bad, and we put the two together. Canada lately has had really good fundamentals. Europe has had really bad fundamentals. We didn't look at the currency pair. Maybe I can really quickly. I didn't draw lines in this, so I didn't even think about it. But if you look at the Euro CAD, it's actually not even a good example. But I guess over the long term it is. So if you look at the last couple months, Euro CAD collapsed. Really bad fundamentals in Europe, really good fundamentals in Canada. That's what we want to see. It's not always going to happen. But I think this approach will at least brings us a lot closer to, like we said, our goal is to create a narrative, to be able to create a story behind a currency pair. I like to look at a currency pair and say, okay, there's two currencies. What's the story for each currency? Is one good and one bad, or is two bad or two good? Also take into consideration the exterior forces. Are they commodity-based currencies? Does one affect the other? Is there a carry trade involved? How does China fit into this? We don't trade the Chinese currency, but the yuan, but it's a very influential, element in our economies. And if China slows down, which it kind of looks like some numbers are, they're going to consume less commodities again from Australia and New Zealand. That's not good. The news, we're bad on the previous news. How do we know to when the Aussie will drop? Well, it's a great question. How do we know exactly what will happen, Mark? We don't. What we're trying to do is simply from a fundamental point of view, we're trying to create a story. The same way we would look at Apple Computer and say, I haven't looked at the stock yet, but fundamentally I know the company is strong. And I think the stock will continue to improve. And RIM, which makes a BlackBerry, they're selling less and less phones every day. And therefore, I think that stock's going to go down more. I'm going to sell short. Now, we haven't talked at all about support, resistance, trend lines, anything like that. But if back to the Aussie dollar example, we'll go to a daily chart. We had, and I'll refresh the chart here. Once we've created this narrative, right, not once, but along the same side we've created this narrative, we also want to apply simple technical analysis. Simple technical analysis is trend lines. Connect uptrending support, up higher lows to create supports, or downtrending resistance, lower highs. When the market's going up, the most important thing is support because that tells us when to buy. When the market's going down, resistance is most important because it tells us where to sell. We can also apply moving averages, which are very, very simple. You take a short moving average like the 10. You take a medium moving average. I'm making the numbers up as we go along. We could take a medium like the 30. We'll make this a different line. And we take the long term. I know I'm almost out of time here, so I don't want to get too far off topic. We take a long term like the 90. There's no magic moving average. I just picked 3 at random, okay? Now, let's erase all the lines. Let's say we don't know anything about the fundamentals. Okay? What do we see here? When the Aussie dollar was going up, the 10 was above the 30, the 30 was above the 90. This is a strong market. That's when the short is above the medium and the medium is above the long. That strong market started January 3rd and ended March 4th. If you had bought the Aussie dollar anywhere from January 3rd to March 4th, you probably would have made money at least until the very end. Now what's happened? We zoom in. The short is below the medium is below the long moving averages, which really did not occur until April 5th, just a couple days ago. Now, this is not an exact science, but basically, this is what we want to do. We want to look for confirmation in the charts. During this period of time, let's say that the fundamentals in Australia were a lot better than they were in the U.S. I want to look for the chart to give me confirmation of that, either through the use of trend lines, moving averages, or both. If everyone agrees, beautiful. Then we just look for the entry. Remember the entry? Wait for a pullback, trade in the same direction as the trend. Risk management, don't trade too big. Use big stop orders. And I think you've come very, very close to getting it right. You know, anything can happen, but anything can happen with Apple computer stock or RIM. You know, there's a lot of people say don't sell short RIM because maybe they're going to get taken out. Maybe, you know, Yahoo or Microsoft is going to buy them and then the stock will go through the roof. That is a risk. You know, we don't know. There's always risk. There's interest rate risk. There's carry trade risk. Well, that's interest rate risk. There's, you know, geopolitical risk. There's risk of war. There's risk of this and that. We don't know. We make decisions based on what we do know. We know how to look at the calendar and to make an assessment. We only look for 1 month. There's a lot of news out there. And we only look for the really big news. Every single day there's news. What I would suggest is start keeping a diary. Write down every day the news. You know, not every piece of news, the big news, the news that seems to move the market the most. In the diary, write down the market's reaction to that. News in the U.S., better than expected, much better than expected, I should say. Excuse me. And write down the market's reaction to that news, and slowly we'll be able to create a narrative. We'll be able to get a much better idea of why the market's moving and hopefully what we can expect moving forward. With that said, I'm officially out of time. I wish I had more. www.forexlearners.com is how you can contact me if you have any questions. Very special thanks to FX Street. We thank you all for joining us. Please see the calendar on FX Street because we have a lot more to talk about. Again, we thank you for joining us. We wish you a great day, all profitable trades. And we look forward to seeing you back soon.